Good morning. Welcome to Scope's Portfolio Management Conference session. My name is Manqing Sun, Mutual Fund Analyst from Scope Analysis. It is my pleasure to have our guest Ulrik Fugmann, Co-Lead Portfolio Manager of BNP Paribas Environmental Absolute Return Thematic Fund, also known as EARTH, in our session today. Welcome, Ulrik.
Thank you very much. Thank you for having me.
It is no longer a secret that ESG investing has become the new normal and dominant trend in the industry. While most ESG funds are tied to long-only positions, some portfolio managers are already making bets by shorting the sustainability laggards. Please join us today to learn more about how a thematic absolute return strategy using long-short approach to capture sustainable alpha. Meanwhile, if you have any questions during this conference, please type in your question on the right bar. We will either answer them directly if time permits or get back to you later by email. Allow me to start with a brief introduction on the fund before we move on to further questions to Ulrik. The BNPP EARTH Fund launched in July 2020. The portfolio thematically holds 25 to 45 long and short strategies across energy, materials, agriculture, and industrial markets globally in response to climate challenge and rising population. The fund follows a top-down approach combined with rigorous fundamental analysis, which targets positive return over medium term with below market moderate volatility. Now let's take a closer look at the strategy, starting with some questions about the team. Ulrik, first tell us about yourself. How long have you been working in the industry and with BNPP? And most importantly, what is background pertinent to this specific theme of the fund?
Yeah, thank you very much, Manqing. My background is that I started in finance in 2001 at Goldman Sachs. I'm from Denmark originally, so I moved to London about 21 years ago now. And I started at Goldman Sachs, where I spent about 11 years in a variety of different investment groups. I started out on the trading side, then in 2004, went over to a group called the Goldman Sachs Principal Strategies Group, which was a group that managed about 15 billion in long-short strategies, but also in private equity, private investments, and credit. But my focus really was always thematic investments, and it was really around energy, materials, agriculture, and industrials, the four areas that we're looking at today. And in 2007, I ended up launching a group together with my current business partner, Edward Lees, at Goldman, called the Goldman Sachs Thematic Investment Group, that we co-ran up until 2012. And that group really invested thematically into the same four verticals that we're talking about today. In 2013, we left. We set up our own asset management company, unsurprisingly, with a focal point on thematic investments, both long only as well as long short. That was later sold and integrated into a large asset manager here in London. Now, in 16-17, we took what was a very broad thematic remit of energy, materials, ag, and industrials, and really focused in on the environmental solutions part of that investment universe, which really led us to arriving at BNP, that had done a huge amount of work around sustainability, ESG, and thematic investments, where Ed and I have come in to really run what is today the Environmental Strategies Group, where we're managing long-only strategies as well as this long-short strategy. So in short, we have a team that has spent a long time together, about 20 years, and we've spent that same amount of time investing in the areas that we're investing in today.
So let's also talk about Edward Lees, your co-manager on this fund. What his background relevant to the strategy?
Yeah, Edward's fantastic. He's not only a very, very close and dear friend, he's also been my co-portfolio manager and colleague for the past 20 years. So it's really quite a unique relationship, and unique having been through so many different markets since early 2000, financial crises, Chinese equity market boom and bust, and the list goes on. So that's really fantastic to have such a close-knit team. Ed's experience goes back to 1994, where he started at Morgan Stanley, doing private equity as well as investment banking, after which he did an MBA at Wharton, and we met at the steps of Goldman Sachs in London in 2001, where we've collaborated and been investing alongside each other for our entire tenure there, as well as starting businesses, a business together after we left Goldman. We also on the team have Isua Bombs, our PhD data analyst and quant analyst that really is incredibly additive to what we're doing, particularly on long short, which we can talk about later. And we are delighted to be greeting a new team member as well, one that we're excited to be having on the team from the 1st of February, who's really going to, with a long-standing long-short experience, who's really going to bolster the team in a very, very positive way. But of course, we also, lastly, work with the rest of the organization, regional equity teams across the globe at BNP. It's a fantastic asset for us to be able to speak to the team in Boston, in Hong Kong, as well as here in London and the rest of Europe. And then, of course, our 25 People Sustainability Center, with whom we discuss issues around ESG in particular.
Mm-hmm. So the questions on the research intelligence that you mentioned, in-house ESG team, how does the in-house research collaboration look like? Do you get any, do you interact with the team to get some inspirations?
Yeah, absolutely. I mean, given that we're a thematic investment product, we have a fairly, what should we say, siloed investment area. We're not investing in general equities such as healthcare and retail and things that are thematically not aligned with the fund that we're in. That said, there are a number of investment teams that do look at this space, and I think more and more portfolio managers do and need to look at this space and finding ways to integrate environmental solutions into their portfolios, because they can see the business opportunity and how the world's changing, and there's a need to then add these opportunities into portfolios for sure. But also with the ESG team, we have a wonderful teamwork. Clearly at BNP, we're integrating E and S and G into all of our investment products. And Ed and I are on the steering committee for ESG and sustainability globally here at BNP. So we have regular interactions with the Sustainability Center around not only ESG, but also issues around engagement, climate data, and really think about how we can keep pushing the envelope on the environmental signal.
Mm-hmm. So let's now steer back to the fund itself. Would you kindly elaborate on the investment philosophy? We know you have a proven track record with another BNP fund, Energy Transition. What are the different focal points of these two funds?
Yeah, that's it's a great question. So I would say first of all, there's a fantastic quote that I've just got up on the slides here from Mark Carney, who said that climate change is not only an existential risk, but also one of the biggest commercial opportunities of our time. And you can see that quote in itself embodies the opportunity that we're facing here, not only on the long side, which is the biggest commercial opportunity of our lifetime, which is a fund, a long-only fund that we have focused really on the energy transition, investing across three themes, which is renewable energy, energy tech and efficiency, and energy infrastructure, transportation and storage. But when we're hearing a statement like this, that it's one of the greatest commercial opportunities, but also an existential risk, clearly with someone with a long-short view, you can see that there's some potential here for winners and losers to develop, and their long-short approach could be, we think, is unique and very interesting. So in terms of our mission and what it is we're trying to achieve here, which specifically with Earth, which is an equity long short product, which is market neutral, plus minus 20% net exposure, a gross exposure between 150 and 200%, meaning that we're fully invested in accordance with UCITS as well. I think that the main points here are a couple of things. One, the investment team that we talked about, having spent an enormous amount of time together, but also the fact that we have spent our entire careers doing long-short, which I think is really important. Long-short investments is very, very different from a long-only approach, and I think that's incredibly important. The next thing is that we have been looking at these sectors and environmental solutions for the past 20 years. And not only those, but also in companies that are today considered brown companies. And I think that gives us an advantage in not only understanding where we're coming from, but where we're going to, in regards to assessing technologies that are going to be the ones that come out on top in the innovation that we're seeing around the environmental solution strategies. We also have quite an active mindset. I think we're very, very risk conscious, and that's reflected in how we hedge and construct our portfolios. And then finally, this element of quantitative analysis that we're bringing in, I think is really something that augments and further strengthens the portfolio, and just making sure that we have something that is genuinely through cycle and can deliver the 6 to 9% absolute returns that we are targeting for our investors in this fund. That said, I think we always mention that we think the return opportunity here is higher given the dispersion that we're seeing in the sector. Mispricings, this is an area where there's still a lot of generalists, and investors are finding it difficult to figure out how to understand and handle some of these rather complex technologies, and that certainly gives us an advantage. And we've been seeing that in the performance of the fund, where on a headline share class, the fund is up 26% in 2020 and about 8% in 2021.
Mm-hmm. So now we come down to, how do you define the universe of this fund? What are the screening criteria? Could you walk us through the process, how you build up the portfolio?
Yeah, so the investment universe is one that we really created from what we thought was an excellent macro opportunity and commercial opportunity, and the investment universe kind of automatically bled out from that. And our basic belief is that this theme is one that's driven by population growth, rising incomes, and urbanization, and that means that the demand for energy, for food, for water, for a number of resources today is going to go up substantially, somewhat in the order of 35 to 50% by 2050, which is an enormous increase in demand for these resources. But at the same time, we also know that carbon emissions and the pressure on our ecosystems are making all-time highs, and we need to do something soon. So how do you balance this additional demand for resources, very broadly speaking, as well as at the same time lowering the carbon emissions and the pressure on our ecosystems? Of course, this is where the market for environmental solutions come in that can balance that inequality. So our firm belief here is that companies that are coming up with environmental solutions are going to outperform other companies in those same markets that either sit with what we believe are transition risk assets, stranded assets, or indeed inferior technologies. So that leads us then straight into the investment universe, which you can see here on the slide, is focused on the 4 verticals that we spoke about: energy, materials, ag, and industrials. And immediately you see how many different sub-themes that we have as part of the fund. So this is by no means just wind and solar. We're also talking smart grids, electric vehicles. We're talking resource markets, so lithium, nickel and cobalt, certain rare earth metals as well. We're talking battery storage and battery technology companies. We are really, we're talking agricultural technology, biofuels. This is really just a very, very broad investment universe, and deliberately so, because it's one that's directly targeted at this macro opportunity and commercial opportunity we've identified. And it gives us enough breadth to really move between themes that we think that we have high conviction in, and that we think are going to outperform in the current market setup. So this is how we define the investment universe.
Mm-hmm. So on this note, one of the highlights of the strategy is that you pair long positions with short exposures, as you mentioned before. What are the main traits of your conviction that you would say generate sustainable alpha, and how do you define and quantify those so-called sustainability laggards or inferior technologies that you're shorting? Could you give us some examples?
Yeah, absolutely. And I think this is probably what most investors would be very interested in, really understanding how the short side works in a long short strategy. And this is something we spent a very long time on creating the architecture for. And what we've done is really become a little bit more explicit, Ed and I, in regards to the type of investments that we are entering into. And we've made it here, we kind of lifted the hood a little bit for the fund, where you can see that we have 3 different types of distinct, what should we call it, strategies within the fund. Because shorts, of course, you can use for 2 things first and foremost. One, you can use shorts to hedge your positions, hedge long positions, such that you avoid drawdowns, market volatility, and a lot of factor risk. And the other way you can use shorts is really by shorting companies that you think are going to go down, and thereby creating additional returns and alpha. So when do we use shorts for what? So on the thematic side, this is where shorts are primarily used for hedging purposes. And hence the shorts are not so much used to create alpha. It's really used to provide an optimal hedge for thematic ideas on the long side, where we think a company is interesting. So the idiosyncratic alpha of the company we think is something that's going to make us returns, but also the theme itself. And hence starting to go short the theme, or indeed companies in the same peer group, is a bad idea, because the alpha signal can all of a sudden be crowded out. So I can give you an example. Siemens Gamesa is a Spanish wind turbine manufacturer that has done a lot in the offshore wind turbine market. And this is a market we think is going to be growing very fast, 60% in 2021, 30% in 2022, whereas onshore is going to be flat or negative growth. So Siemens Gamesa is something that's interesting for us on the long side, not only as an idiosyncratic signal as a company itself, but the whole offshore sector is one that's growing very fast, and that is not something we want to be short. So how do we then think about hedging there? Because clearly, if the market goes down, Siemens Gamesa could still go down, and there's a number of other factors that can affect Siemens Gamesa, and factors are really the key word, because we identify all of those factors that are not the company itself and that are not the theme, but that still affect the equity price of a Siemens Gamesa. Examples of that could be momentum as a style factor. It could be the Spanish index as reflecting sovereign risk. It can be industrials as reflecting risk around capital goods and the broader industrial activity, and other factors like that. So we will hedge out momentum, we will hedge out some Spain sector risk, we might hedge out some industrial risk to really make sure that if the markets fall, or if industrials fall, or if Spain sovereign risk rises, that doesn't affect the equity position of Siemens Gamesa. So that's on the thematic side, and that's about 40% of the portfolio. The next one is really relative value. That's the other 40% of the portfolio, which is classical long-short. So when I say classical long-short, it's really company A versus company B within the same sector. Here you're very much neutralizing market risk, sector risk, and you're really playing for a market inefficiency or a mispricing of companies in the same sector. But this is where it gets really fun and interesting, because it opens up for doing things in not only carbon intensive sectors, but also within sustainability. And I think that bears and deserves a little bit of explanation. And I think that's best illustrated with two examples. The first example is thinking about a relative value trade within a carbon intensive sector and how that can actually generate a net positive impact. There we've had a long investment in a company called Nucor. Nucor is using renewable energy to fire up or to operate their smelters. And the way that they buy input is by buying scrap steel, i.e. recycled steel. So Nucor is very much part of the circular economy, buying up recycled and scrap steel, putting them into a smelter that is fired up by wind or solar or soon enough hydrogen, what we in other words call green steel. And out comes a fairly green, not very carbon intensive steel product that the automakers and the building sector loves, because they themselves under pressure and understand the need to decarbonize the value chain. So in and itself, it makes sense for Nucor because the consumer demand, industrial demand is certainly there. And on the short side, we still see companies, unfortunately in the steel sector, that are using what's called a blast furnace. So these are smelters where you buy iron ore and you buy coking coal, some of the most polluting extractive industries, and you put that into a smelter. It's a little bit like a pizza oven, if you will, that is very hard to turn off. And out comes a very carbon intensive product and a production process that's very inflexible and with input costs that are very volatile. So in other words, here you have a green steel company versus a traditional brown steel company. So the net impact is clearly quite positive. We need to decarbonize all sectors, not just wind and solar can contribute to decarbonization, but certainly also the carbon intensive sectors. But whilst having the long side being greener than the short side, which is browner, is a necessary condition for us, but it's not sufficient. At the end of the day, we are a returns first fund. And when we put on a relative value investment like that, it is because we believe that green steel, in this example, enjoys higher returns than traditional steel companies. So not only are you receiving the positive net impact, but also higher returns. Now let's go into a similar example where we're doing within sustainability. Let's say that we're short. Let's say we're going long and short within the solar sector. So this could be going long a solar company that have superior technology, that are really doing a lot to decarbonize household energy and power production. And against it, we can be short another solar company with a commoditized offering of, let's say, solar panels that are X-growth, where the technology is clearly behind, which is and ultimately is something that will not quickly enough take us to where we need to be in regard to the Paris Agreement, as an example. What we need to do is invest in technologies that are speeding up the decarbonization and making sure that we continue to evolve and innovate. And hence, for us to short out companies that are not innovating, that are not providing superior technology, that are not continuing to invest in R&D to speed up the decarbonization, we will happily short, with the consequence of raising their cost of capital, and hence really diverting capital towards those solutions providers away from companies that are either unable or unwilling to continue to sufficiently quickly speed up the decarbonization. So that's an example of how we can do that within sustainability. And finally, the last leg, and then I'll be quiet, is on the catalyst side, which is something that really lends itself very well to our team with 20 years of experience, very close to industry, where we see events that are generally overlooked by generalists, but these can be electricity auctions, it can be a change to tariffs in China or the US and Europe. It could be a corporate action, spin out, or certain business lines where we see companies meaningfully change, and hence there's a defined catalyst. There's and a certain event that we've identified that will meaningfully change the future path of a company's equity journey. And that can either be on the long side or on the short side. And we will use those catalysts to take either long positions or short positions to add value into the portfolio. So that's how we generally not only look at the portfolio, but also how shorts are being used, as in not just as hedges to in the thematic side to really hedge our long positions and themes that we think ultimately are going to grow in importance and in value, but also using shorts as a way of adding alpha on the downside and neutralizing at times the sustainability bias, if you will, because whilst the sustainability is great, this is an area that can also go up and down, and we will see, just like we've seen rallies, we will see sell-offs, and what the fund really is there to do is to make sure we can continue to support companies even during those sell-offs by being short the ones with inferior technologies.
Thanks for walking us through the three pillars. I think we now have the idea how you build up the portfolio, at least about the screening criteria a little bit. What else do you think makes the fund unique or stand out compared to its peer group of in its peer group of equity ecology?
Yeah, it's I think first of all it's of course the long short approach. I think the long short approach here is really quite unique. And I think it's hopefully something that we're going to see more long short funds embracing and doing. We think certainly with our skill set and our experience, for us this comes very, very natural. But I also think that it does require a sort of long-standing experience in being able to manage shorts and manage hedging, which is a non-trivial exercise, and one that requires quite a lot of work relative to doing long only. I would say what's maybe not so unique, but certainly what is special to our approach is this idea of blending fundamental analysis with some of the quant work that we're doing here. And you can see our investment process is one where we're really very much top-down, bottom-up. And the first three steps in our investment process is really focusing on starting from the top, looking at the macro environment within in which we're in, thinking about regulatory issues and themes, as well as industries very broadly where we can find environmental solutions. And that in step 2 and step 3 where we're integrating ESG in our analysis, as well as quite deep environmental footprinting. This is where all of the themes that we want to be long and themes we want to be short are kind of coming out of. And in the last 3 steps, it's really all about how we then do a deep dive, bottom-up fundamental analysis. We integrate some of the quant work that we're doing there, and that's really a lot of that is really also focused on how we construct the portfolio and how we manage risk. So I would say the portfolio construction and the risk management is something that is, I think, rather unique. I think it's what makes this mandate quite strong, and is very suitable for the 3 different types of strategies that we went through before.
Mm-hmm. So what do you use to facilitate your research with? Do you use proprietary model for the quant investment or external third-party service?
Yeah, it's a great question. I mean, we are a dedicated environmental strategies group here at BNP. We do all our analysis ourselves. Of course, we, to the extent possible, leverage networks. So this can be industry in general, speaking to management teams, speaking to industry specialists, industry bodies. We speak to sell-side banks. We have a very broad network where we can test and ideas and kind of think about what's new. We speak to a lot of private companies as well that are not necessarily publicly listed, to really gauge where things are moving towards. So in terms of research, there's a lot of primary research we do, rather than just consuming secondary research, which are research from banks, etc. Which also means that we can sometimes be early. We also avoid having any bias towards research that are then released from banks in general. And in terms of so that's more on the fundamental side. On the quant side, these are all proprietary models that we've spent the last decade, 1.5 decades building, that really started from living in Excel spreadsheets, but the world has moved on from Excel. And we now have a couple of million lines of code sitting in Python. We've built our own application here that is incredibly efficient in just trying to highlight and put some meat around optimal hedging. So we have a huge database with thousands of instruments that are tradable across the globe, where we run investments through, and the outcome of that is through a number of time series optimizations, is to really look at how we can create stability for each and every asset and allocate individual hedges. And we do that on an asset by asset basis. So when you roll up your entire portfolio, you have something that has a very, very high probability of being very tightly hedged, and really withstand drawdowns as well. And that's really where our focus is, to make sure that we can capture enough of the upside in the market, but really limit what we capture in terms of downside. And if you can do that over time, I think you have a very successful strategy.
Let's move on to the current portfolio status. Is there any benchmark constraint on the allocation?
No, we don't have any benchmark as such. So we're an absolute return fund. So we don't try and be slightly better than markets. What we are doing is we're targeting in all market environments, market up, market down, that we're generating positive absolute returns. So if the market's down 20%, we should still be in a position where we can generate 6 to 9% absolute returns, given our ability to both going long and short. So we are not as such benchmark agnostic. What we do is we have some internal guidelines and systems for looking at cross correlation in the portfolio. So one of the things that I think we're quite proud of is that the correlation of Earth since July has pretty much been zero to the market, which is really what you want to do in a hedged strategy. You want to have low market correlation. And if you combine with low market correlation can capture upside in the market, I think you have something really quite precious. And that's certainly what we've been aiming at doing for the fund. We also have a fairly diversified sort of spread on geographies. We are investing in Europe, US, and Asia as well. We have taken our US allocations down a little bit. We have increased those in Asia a little bit, where we see more opportunity. But the way that we really manage these concentration risk is through what we call a fundamental bucketing model, where we can monitor concentration risk on a number of different factors, 35 or so across the portfolio, and really highlight where we have concentrations. And that could be simple stuff like geography and sectors, etc. Then it could be some slightly more esoteric stuff like volatility, maturity of the spread of maturity of investments that we have in, are they 3 months, 6 months, 1 year investments? And then finally, something that I think few portfolio managers have, but where we're trying to quantify what is the credit risk in our portfolio by looking at refinancing risk year 1, year 2, year 3, and aggregate up across our portfolio. And we don't just do that for it to sound smart. It actually has a very practical implication, because if there's issues around if there's some issues around macro and a credit-led downturn, and you know what your credit risk in the portfolio is, you have the ability to react, not only react, but also be proactive in regards to hedging some of that macro risk out, or credit risk or interest rate risk that you have in your equity portfolio. And I think that's important.
Mm-hmm. So what's the status of your long and short exposure in the portfolio right now? How do you pair them in your portfolio?
So right now we are running with a fairly low net exposure in the portfolio. So we don't have any sort of outright long, outright short exposure. So a very low net portfolio. We have certainly hedged growth quite aggressively. We think that generally, if you think about environmental solutions, there's always a growth bias there because of the innovation and technology that we're seeing applied for environmental solutions. And we have a fairly strong conviction that in this battle between value and growth, that value is going to outperform in 2021. We have a strong conviction that oil prices are going to go up significantly as well, which will further bolster the value argument. We think that there could be some risk. We don't see it right now, but we think there could be some inflation risk, and hence for rates to go higher, not by central banks, but by fixed income markets. And hence, that is something that equity markets don't always like, but it depends on the speed at which they go up and the background. So that's why we're running low net. We have got a style hedge across the portfolio to hedge out growth and really to introduce a value component as well, which is harder in this investment universe, but one that we've worked hard on introducing, and I think the fund has really benefited from, not only in November, December, but also in January, and I think for the rest of the year.
Mm-hmm. So in this regard, how do you size the positions? What's the maximum cash position, for example, for the portfolio?
Yeah, that's a great question. So a lot of people will use net exposure as a way of managing risk in the portfolio. But if you think about net exposure, that's kind of trying to predict market direction. And in my experience, very, very few people or investors are actually very good at catching changes in market trends or even figuring out whether the markets are going up or down. So rather than using net exposure as a way of controlling for risk, we actually tend to use our gross exposure. And that means when we're investing and volatility goes up, typically what happens is that the cash allocation can tend to increase. And that's a result of a stop loss system that we have. We have very, very tight stop losses, meaning that we don't allow things to sit and lose money for a very long time. We stop our positions out on the downside, but we treat that symmetrically. We also stop positions out on the upside. And what that means is that if a certain position has reached our target price, what we fundamentally believe that position is worth, or that equity or company is worth, rather than continuing to hold it, and even so in the right size, we're actually, as the equity is going up, sizing that position down, because the risk reward, of course, is getting worse. And once it's getting to our target price, we will sell out of it. And hence, when you are experiencing market volatility, you can imagine that you're going to hit your upside stops or your downside stops quicker, and that means the portfolio go more in cash, which is a beautiful instrument because and way of managing risk, because typically when market goes up, when volatility goes up, it means that there is some market uncertainty, and if you during market uncertainty get thrown more into cash, it means that you can be much more opportunistic to take advantage of those oscillations. So in terms of position sizes are typically somewhere between 2 and 6%, I would say, of net asset value. And each and every position is individually hedged. And we then roll that up into one big portfolio and make sure it all makes sense. And sizing is something that we are determining in a very systematic way, actually. Which comes from how we think about upside targets, downside targets. We create risk-reward ratios. We normalize those risk-reward ratios by volatility, liquidity, conviction, and correlation. And hence, the more volatile, the less liquid, the less conviction we have, and the more correlation an asset has, the smaller the risk-reward ratio will get. So already in our sizing, we're taking into account a number of risk factors that can affect the equity.
Okay, so where did the majority of active performance come from over the last years? Which theme have done particularly well, and which region could be of interest to the investors from your experience? What are the main alpha sources?
Yeah, so I think the fund has had investments and participated really in the hydrogen fuel cell area. We invest across market capitalizations, which is another diversification factor of the fund. I think most people tend to invest in large caps because it's more liquid area of the market. But in fact, that's where we see some of the highest risk because of crowding. And the less invested and less crowded area really sits in the small to mid cap area. So hydrogen fuel cells we see as of growing interest for everyone. It's the addressable market is really exploding in many ways, no pun intended. But I also think that we need to be very careful how we deal with hydrogen. There's green and blue and gray hydrogen, and there we're particularly positive on the green hydrogen, and that's an area that's added a lot of alpha to the portfolio. We've also had investments in the U.S. residential solar area, which is also an area that has really added performance. On the EV side, the fund has also been quite active. And not just in personal mobility, but also in transit and last mile deliveries. You saw there was an announcement yesterday by the Biden organization to really change all federal institutions' vehicles from diesel cars over to EVs. So this is when British Gas comes out here in the UK and checks your meter. They come in a smaller car where they have tools in the back. Well, there's a lot of companies in the US that are focusing on changing that entire park of mobility So those are companies we've invested in, also companies on the smart grid and technology side that are doing a lot for grid optimization, power optimization has been good. We've had a very successful investments in the agricultural space, not only around biofuels after Biden became president, but also in agricultural tech, so vertical farming. I mean, it brings a smile to my face because these are companies that I'm passionate about. These are some of the most interesting companies in the world with huge addressable markets, and we've got conviction that they're going to continue to perform well.
So far, we have covered the portfolio from a performance perspective, but risk management is also a crucial part, especially when you have short positions in your portfolio. So for the Earth Fund, are there any explicit hard limits of the fund?
Yeah, I think so. The hard limits, first and foremost, start with the gross and the net exposure of the fund. So gross exposure never exceeds 200%. Net exposure is maximum plus minus 20%, meaning that we can both go long and short with quite limited directionality. But typically, even because we're not a directional fund, because we're one that's just trying to bleed out some outperformance and some alpha over time, we typically lie between plus minus 10% net exposures, just so with very, very little market directionality, and really focus on alpha and finding alpha signals in what we do. But otherwise, we really leave ourselves enough leeway to be able to go between themes, but still have our internal guidelines for concentration risk, for correlation in the portfolio, etc. That we adhere to, as well as stop losses that I mentioned before. That I think is integral to managing long short. People have different views on stop losses. Some people don't use them at all. That can lead to very high volatility. Other people use stop losses, but they wait a long time until the time of maximum pain, and then they stop themselves out of positions, which can be very, very hard to do, and in our minds is a mistake. We believe in pretty tight stops because it means that we sometimes will be wrong when we go into a certain investment, but because we've applied tight stops, we have the ability to go back in if we believe the theme is the right one after a certain cooling off period that is determined by, amongst other things, by short and medium term volatility.
We know the fund is benchmark agnostic, as you mentioned. For a thematic fund like yours, do you see any risk of clustering due to its nature of the strategy? How do you control such risk, or do you see any risk of that?
Yeah, it's a great question. I think clustering can happen in two ways, and that is if you feel you have the same investment on 20 times, and hence your correlation within the portfolio all of a sudden spikes. And this is something that we spend an enormous amount of time on. Really making sure that our investments are decorrelated. Not only the strategies need to be decorrelated between each other to the highest degree possible, but also when we roll up the portfolio, we need to, of course, make sure that we have something that's as uncorrelated to the market as possible. I suppose that's always the right question to ask. I think ultimately managing people's capital is a very personal thing, and hence I would say the first thing really here is the team. We're a team that spent more than 20 years together, investing as a group together in markets, in up markets and down markets, and markets with black swans, and been managing long short portfolios all that time. And I think having that experience, having managed long short for that a long time, and building portfolios, having sort of been sitting on the front line, is incredibly important, an experience that's very hard to kind of learn, but experience that you build up over years. And I think we have a team that all bring that to the table. And related to the team is, of course, also the fact that we spent not only the 20 years managing long-short portfolios, as well as spending that time investing thematically, but we've specifically spent time in looking at the areas that we're talking about today, namely environmental solutions companies. But not only that, as I mentioned before, this idea of having invested more broadly, both in the brown and the green, means that we have a very strong appreciation of where we're coming from and where we're going to. So the first point is really just around the is around the team. The second, I would say, is that our fairly unique approach to how we think about the portfolio construction and risk management. I think we have a very I think we have a way of blending fundamental equity views that ultimately are coming from our experience, our know-how, our networks, and the analysis we do, and really blending that with some considerations and models around data science and quant, and making sure that sizing is not something that is an emotional exercise, but rather a systematic exercise harnessed in what we think appropriate risk rewards are. As well as risk management, where we're doing a lot of work on style, etc. And the group there also has a very strong and long-standing experience using quantitative tools. So to summarize, first the team, and I would say second, the quant approach. The third strength, I think, and why people should be investing, is of course that I think this is something that not only has strong net positive impact, and in a way where people can support companies over time and do so without suffering from the substantial drawdowns we can see in markets, as evidenced in COVID in March, that we can see that these things can happen very quickly in the space of 1 or 2 weeks with quite severe drawdowns. And where investors feel that they can have a through-cycle strategy of generating absolute returns in a way where they not only are generating positive impact, but also quite attractive risk-adjusted returns. And the way that those are being produced, you've seen, is not only by a quite sophisticated, I think, hedging regime, but also the ability to actually make money from equities that have transition risk or stranded assets. So first, the team. Second, the combination of fundamental and quant approach to investing, and then I would say thirdly, the approach and the architecture we have for investing in environmental solutions that I think is unique.
Mm-hmm. I think these three arguments deliver a clear message to the potential investors out there. So let's wrap up the meeting with questions regarding the outlook. We mentioned fund energy transition, which launched with great success. Now the team took a step further with thematic fund Earth. If Earth is a revolution to the energy transition, what could be next for the team?
Yeah, that's a great question, and it might be a bit early that I'm lifting the lid on this, but why not? Energy Transition is a fund that's had tremendous success, and we're very happy with it. We've been able to support some of the most interesting companies in the world, I believe, with it. So both the companies we're investing in and our investors are winning on all accounts. The fund launched in the Energy Transition Fund launched in August of 19 and has since then made a little over 200% returns. through its all cap approach. So we're investing in small, mid, and large caps to really avoid just having this crowding element that we talked about before. And the fund has grown from 120 million, euros to about 3.2 billion today. So tremendous success, not just for our investors, but also for the companies that we've been investing in, that we've been able to support over time, and that have generated value for our clients and certainly for their own businesses. So that's the Energy Transition Fund, and that continues to grow. Of course, Earth, we launched with about $70 million. That's grown to $250 million today. So we see strong growth there, and we're incredibly happy with the investor support and how that fund has been received, and really complements the long only mandate. Now, what's next? Well, wait and see. But in April, we are launching a ecosystems restoration fund. It's a fund where energy transition really is dealing with carbon issues related from energy-related activities. The ecosystem restoration fund, this long-only fund that we're launching in hopefully April, deals with nature. It deals with oceans, it deals with land, and it deals with how we built our cities and buildings in a way where we're no longer degrading nature, but actually can integrate and restore the nature. And there's a number of companies that are focused on oceans, that are focused on the betterment of land and food and agriculture, as well as thinking about how we can build in a more green way, how can we interact with nature in our cities in a smarter way. And that's a largely overlooked investment opportunity, we think. And there's a lot of companies that are facing a commercial opportunity in the next 10 years, which has been identified by the World Economic Forum, of $22 trillion of net capital investment into our ecosystems, bearing in mind that half the world's GDP, 44 trillion, is either moderately or highly dependent on the ecosystems around us. So having an investment mandate that is able to not only help the oceans, land, food, and agriculture, and how we think about building our cities, I'm super excited about, and I think it's going to be one of the strongest investment themes for 2021, bearing in mind that ecosystems and that entire universe is 40% of our Earth portfolio. So we're already invested in it today. We can see that it's already made money, and we think it has an extraordinarily strong upside for the next decade.
So we hope you all enjoyed today's webinar, and see you next time.
Thank you very, very much for having me.